festival greeting to everyone. It's the season of festivals starting from Ganpati, and then now series of celebration in India will have going up to the month of January till Pongal or Sankranti and so on and so forth. Second, I think India has been managing the tariff situations quite nicely. I think India in a very mature manner tackling with the issues that India would face if the tariff is being implemented on as it is basis as is being discussed. I must compliment and the government, the respective authorities, to handle this with a calm and cool mind, and how to ensure that India as a country continues to try towards a higher growth path and becoming one of the prominent players in the world. And that's something is the one which is also reflected in the stock market, not having too much of volatility despite the issues of high uncertain nature. The Indian equity market is quite resilient. And second, in order to, I always seen historically, whenever as a country we are pushed to the corner, as a country we start using some of the real power that India provides to uplift the economic growth due to the large pool of Indian population and potential with the consumers. That's something India has now done it by aptly recognizing the need to cut the GST rates so that the goods and services in India come down, therefore more consumption happens. In order to even support that, Reserve Bank of India too have been cutting interest rates in India. Even US, the rate cut has not been coming as much as being expected. But however, India has been quite in the forefront in cutting interest rates, and which essentially means the cost of capital has to be low and the growth has to pick up, the volume has to come. Therefore, all these actions being undertaken before the busy season, which I call it as a festival season or busy season, before that they are taking the proactive measures, in my view will bring back the growth momentum. So naturally the GST is actually meant for goods and services to come down in terms of cost. And naturally the sector that should be the large beneficiary of this is the consumption driven sectors. Basically I would say the companies which have got large pool of their sales coming to B2C, that's the business to customers, as long as that pie is very large from the turnover point of view, naturally these companies generally tend to get the benefit. And in fact we call it the consumption theme is one of the largest theme in India. And as we all know, that two themes drives India's growth. One is the infrastructure investment to make the India sustainable over a long period of time. Second is the consumption, which all of us consume various goods and services on a day-to-day basis. That's a large pool of Indian drivers of Indian economic growth. The sectors like automobiles, just a ballpark number, the month GST cut was announced, there are many of the car prices come down from ranging from 2 lakh rupees to going up to 7 lakh rupees, which is the significant reduction from the consumer point of view for them to rethink in terms of buying a vehicle. The same way they rethink in the form of buying goods, otherwise they would not have bought in the last 3-4 years for a variety of reasons, and they would start thinking about buying these goods as well as services. This is what I think the GST would lead to ignite the economic growth by way of boosting the consumption in the country, which essentially means the sector could benefit FMCG, automobiles, and tourism sectors, hotel industries. All of them I think would probably the largest benefit they will get it, and the consumer discretionary will also get the large pool of benefit. Therefore, the best way to play always is, I think ABSLAMC Mutual Fund, I got a fund called Consumption Fund, which used to call as Gen X Fund, and in fact there is a 20 years of track record, consistent investment performance it has given for the last 20 years. It's also become a natural choice to take this as a fund, not as a thematic, something was sustainable for longer period of time, because consumption in India is a temporary, it's a permanent. See, often we get worried that foreign investors are removing money from India. I must mention, when they come with big bang. When they also go, they go with the big bang. And they withdraw also, they withdraw at the equal amount of speed. In fact, when they redeem money from India, we must also be happy. It is the only market where they made a lot of money. I must mention that they have been investing across the global market. They would have invested in China, they would have invested in various other emerging markets, including Brazil. Whereas India is the only market where they made lots of money. Therefore, they go back with the profit, will also make them feel good when they want to come back to India. That's one, which is more philosophical answer I'm giving. At the same time, as the interest rates in US starts coming down, right now they have taken the first path of 20 basis point rate cut. And my own belief is as the economic slowdown starts reflecting in US, in order to get the growth back, and there's high probability US will undertake 100 basis point rate cut in the rest of the I would say rest of 12 months period, I would say, over the next 1 year period. As interest rate starts coming down, as interest rate become more cheaper, they need to also relook at allocation towards various market. In that, when they relook at allocating to the emerging market, and India would be the prominent player to receive maximum flows from overseas investors. Therefore, I would assume having now gone up, it can only come back, and which in my view would be driven by the low interest rate, high liquidity that could prevail in the global market. Therefore, money will get converted to India. And last but not the least is Indian market having gone through a consolidation. At some point or other, the compelling story will come for India for them to actually get back on growth as the corporate earnings starts coming in. See, at the end of the day, most of the global investors chase earnings and basis which they invest. As our nominal GDP growth, which currently less than 10%, where GDP growth plus inflation being low also has an impact on nominal GDP growth. My belief is as the nominal GDP growth comes to about 11-12%, which is a combination of inflation, GDP being somewhere around 8%, inflation being somewhere around 4-4.5%, believe me, the overseas investors will come back very quickly. Therefore, that's something we have to keep this as a hope, on the basis of which we should also continue to make the investment on equity, using the current consolidation phase as an opportunity to build our equity portfolio. See, gold as an asset class have gone up quite substantially for a variety of reasons. It's not just owned by only the common man for the purpose of jewelry purpose. It's also bought by sovereign funds. The government sovereign fund has been buying as part of their reserves, dollar reserves, and basis which also it has increased the prices quite substantially. The demand and supply, if you look at it, it's more towards demand, less of supply, therefore prices have gone up. For everything, there is a price up to which you can invest. I think there is a rationality which comes in. Therefore, basis, if you look at it, gold probably we would say has quite substantially moved up. Therefore, incremental growth in the gold price momentum would come with some amount of added risk along with that. At the same time, silver as an asset class is one of the asset classes. Is not a household owned so much, but they can industrial metal. And given the fact that so much of investment is coming into the electronic manufacturing and EV vehicles, all of them actually users of silver as one of the industrial metal. Therefore, the demand from that segment, other than the household, demand is also rising, and therefore silver as an asset class in all property can do better. But having said that, the best way to participate not buying these precious metals directly. It has got its own impact cost of buying and selling, and the making charges. All such things exist. And as it is, any jewelry that you make is not going to vary today. It's going to be sitting in the cupboard. Instead of that, you can buy into fund of fund, which actually invest in both gold and silver as a class. But that's the best way to actually own it. And because of the diversification of gold and silver, it can also act as a hedge against each other. Also helps you participate and build the portfolio over time. See, nothing changes. Everything remains permanent when it comes to the question of investing in equity, which is nothing but building a portfolio with a core portfolio, which is comprising of large cap fund, flexi cap fund, and mid and small cap fund. And also for the conservative investors who predominantly invest in equity with some kind of safety in their mind. Okay, equity always comes with risk. At the same time, many people want to take an equity taxation, at the same time carry a relatively lower risk, because the balanced advantage fund could be a product which could form part of everyone's portfolio. And as long as you stick to these 4-5 categories, the large cap, flexi cap, mid cap, and multi-asset allocation fund, which invest in all the 4 asset classes, and balanced advantage fund as one of the asset class, if one keeps investing in these asset classes, is more than enough from the point of view of building a portfolio.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.